Good morning, everybody. Welcome to Future Friday. We are so excited to have you all on here. I see lots of new names. So for anybody who doesn't know me, I'm SG. I'm the marketing guru on the Jennifer Jones team, and I lead the weekly Future Friday call. This morning, we have Michael Ford on from Ford and Associates sharing tax tips and tricks, specifically for you guys, for realtors. So, Michael, I'm happy to hand over the floor to you, and then we can get going right away.
All right. Thank you. All right. Good morning, everyone. I'm here to present some tax tips and tricks for independent realtors, and and how to keep you more of what you have legally. Okay. Next screen. Sorry. There we go. Once again, my name is Michael Ford. I'm a senior accountant with Ford and Associates. Been doing this, oh my goodness, it's going to be over 25 years. So let's just put quarter century, make it really feel old. We are based in Newmarket as well. So we'll get it right set off. Why realtors overpay tax? So the four most common mistakes. There's no tax plan. You're just filing at year end, getting all your books and hoping for the best. You're mixing personal with business spending, missing deductions or claiming risky ones, not knowing when to incorporate. I know that's a big question too that comes up. Just keep in mind that CRA doesn't reward last minute panic. Planning saves more than deductions alone. Which one are you? So obviously with businesses, there's two types. So sole proprietor, your income tax personally, but it's simpler, but higher tax with higher income. With the corporation, a lower small business tax rate and allows for income deferral and planning. One of the first questions you need to ask yourself for incorporation is, if you constantly earn 120 to 150K, incorporation should be reviewed. And I'm talking about after expenses, okay? This is just kind of a pros and cons. So as a sole proprietor, some of the cons: unlimited liability. You don't get EI. Your income is subject to personal tax rate. Income is taxed even if not taken out of the business. Record keeping is required with everything. And you must have a December 31st year end. The pros: you're eligible to deduct expenses. Income splitting with spouse, that's when you get a little bit older, senior years. Inexpensive to set up, and no need to register a company name. What I mean by that is a company name legally, like a corporation, not just a tag name, as I call it with Ontario. When you incorporate, some of the cons: yes, it's initially more to set up and maintain. However, long-term, the benefits are, the benefits of the company expenses outweigh the initial outlay. So I have somebody coming in the office, so I got distracted. Obviously in record keeping, everybody loves that, doesn't it? The pros: eligible to deduct expenses again. Leave money in the corporation and pay only 15% tax in Ontario. That's on the corporation side. Limited liability. You can get EI premiums because you can write yourself a T4. Income splitting. And this is income splitting within the corporation, not personally. You can create a good long-term savings plan. It broadens your ability to get contracts. A lot of corporations a lot of other businesses like to see other businesses. And higher hourly wage. What that means is you get to pick how much you want to pull out of the corporation. What is taxable income? Well, it's just more than your commissions. You get your MLS commission, referral fees, team overrides, bonuses, incentives, and the most common issue that I see is your HST is collected. Remember, it's not your money. It's a trust fund from the federal government, and that's usually where a lot of people I see get nicked at. So we're going to talk about some maximizing your deductions and managing some expenses. Okay, so some of the top deductions we can use with CRA is your vehicle. Obviously, for you in your field, the vehicle is obviously the number one. But remember, it's the business portion only, and we'll talk about that a little bit more afterwards. Obviously, marketing and advertising, brokerage fees, CRM apps and software, also known as SaaS fees now, your home office, education and licensing, and professional fees. So let's get to your the vehicle expense. It is the number one audit area in any business, but they do pick on sidewise certain industries. Your industry as well, obviously, is a number one. So there's depending on if you're incorporated or sole proprietorship. We always need to have a mileage log. It is required. That is basically how CRA differentiates your percentage of that vehicle. Business and personal split, that's that percentage that we get from the mileage log. Do you lease it or do you own it? There's some advantages to one and the other. And obviously, everything that runs your vehicle, your gas, insurance, maintenance, etc. And just as a quick tip, if there's no log, CRA assumes zero business use. I have prepared many tax returns just based on the client just giving me information and not giving me a record just to take a quick second peek at it. And they always get picked. And when we send in all the details, either the numbers don't match or CRA just says no. Oh, I'll just go back to the vehicles. There is geo-tracking devices. CRA actually has approved one. It is from Microsoft. It is called Mileage IQ. It's an app. It's one of the only, I think it's the only one at the moment, unless they've approved some others, that is CRA recognized, that pulls out the information you need. It goes on your phone. It knows when you're traveling. So when it measures that you're going more than 5 kilometers an hour, it obviously means you're in a vehicle, unless you're good at running. And at the end of the day, you just basically, just like Tinder, swipe right for it's personal, swipe left if it's for business. And it's a great app to keep. Plus, you can invite your accountant to go in and pull necessary reports. Your home office. Okay, so it's always been kind of on their radar, but right after COVID, and especially now, since everybody wants to work from home, not just your industry, I'm really talking about other industries, it has become looked at. So when you claim home office, you need a dedicated workspace or somewhere where you usually regularly for admin. So the dedicated workspace, if you're lucky enough to have maybe a bedroom that's not being used or somewhere that's already designated as a room in the house, that's perfect. But if you're using the kitchen table, dining room table, you do have to measure that square, all right? And just like with the vehicle expenses, the square footage of your workspace divided by the square footage of your livable square footage. So one of the disadvantages of the livable is if your basement is finished, it's now livable. If it's unfinished, it's not livable. So depending on how you are, you can get a better kickback from that. Common errors. You can't claim 100% of your internet, especially if it is at your house. It's not at a registered commercial location. as I was talking about, inflating your square footage. We just mentioned that. And double claiming expenses. So what I mean by double claiming is if your spouse is also working from home and using the exact same office or area you are, you're now double dipping. So you watch that, because CRA will look at your spouse and see if they're claiming any home deductions as well. Oh, the fun one. GST, HST for realtors. This is the biggest one I see, especially for brand new realtors coming into the business. They're making their money selling the house, and then they're getting stuck at this one. So key rules. It is a mandatory registration over 30,000. Even if you're in your first year and you're not making a 30,000, just register it anyways. The reason being is because you're going to get some ITCs. You will make over 30,000 pretty much, especially if you're going to do it full time. But at least at the beginning, you can get some ITC. And ITCs is just income tax, input tax credits. You must charge HST on your commissions. I'm pretty sure your broker is probably doing that administration already, which is great. Some of the danger zones, late registration. You want to register as soon as possible, because the date of your registration is the date of you starting, especially claiming any ITCs. You can't go backwards from that date. Unless you're a corporation, there is like a 30-day window. Spending the HST before it's remitted. Just like for income tax purposes, for taxes, you should be keeping that aside. Create a separate account. So usually when you first start, you're a once a year remitter for GST until you start making more, and you can become a quarterly. Get a savings account and automatically put that money in it. So when you get paid out, look at your statement and say, that's how much they held back. Immediately put it out in there. It's just going to prevent you from accidentally spending it. But there is a savings portion to that as well that I try to blend in, is when you are saving the full amount of that HST, and at the end of your period, you add up your ITCs, and that's going to be that's your savings plan. So you won't be giving fully CRA everything back. Now you have a little savings, and you can use that for whatever you want. You can keep it for savings, or maybe throw it into some marketing, or what you need. Try to look at it as a different angle. And obviously mixing personal purchases. So I know this can be hard sometimes, especially if you're going, say, to Staples or maybe Walmart or even Costco, is if you're going to buy something for business, don't keep it on the same receipt. Try to really separate your business and personal. I know sometimes it feels unnecessary or feels like you shouldn't do, but it really does help at the end of the day. Give me a sec here. So this is a little diagram that I've picked up. Just kind of shows you the real estate commissions, the residential. You guys already know this, unless I'm going to be dealing some brand new people here online. That's just a graphic that I've been using for years. Paying yourself the right way. So this kind of goes back into the area of corporation, not necessarily, obviously, sole proprietor. When you open up a corporation, you do have the benefits of salary or dividends. So a salary is CPP. It makes your CPP builds up and your RSP room build up. But for lenders, and you probably already seen this many times trying to close sales, the lenders like to see a T4. A T4 is a locked-in official number that goes in, even though they'll probably ask for proof and whatnot, but it is something more official for creditors. Dividends, they don't look at that. Basically, even though it helps you save tax, and you don't even get any CPP for that, it's excuse me, it's something that is like an investment. really with a dividend. An investment in your corporation that you're now pulling out every year can be different. It's really used to balance out for tax savings. But if you're somebody who, like everybody else, every 5 some years you're going to have to renew your mortgage type thing, you want to make sure that you're giving yourself a T4. It just helps out. And the best strategy is we often blend and review annually. So there'll always be a salary. If you're always making the same amount, we'll give you a fixed number that you can pull out every month, 2,000, maybe 4 or 5,000, depending on how much you're making. Make it be like a job that you're getting straight from the employer. And then whatever's offsetting is when we make the decisions of dividends. So some of the advanced planning tools for yourself, and basically this is really for everybody, your RSP versus TFSAs, that strategy. Again, a T4 will build up your RSPs room. Spousal income splitting, that, like I said, that usually happens when one of your spouses start getting a pension. Early, you can start moving that around. The health spending accounts. So this is a corporate strategy for medical. You can, as a corporation, well, even as a sole proprietor, you can go get medical health benefits. But it always comes around that they only cover 80%. You might go into 100%, depends if you want to pay the extra. But what about the extra 20%? Well, who's going to pay for that? With a healthcare spending account coming from the from the benefits company, your corporation pays for it, and it allows the corporation to get an expense, and you not really paying it out of your own pocket. It can be reimbursable, so it is very good, especially if you have a lot of medical procedures or prescriptions or whatnot. That is a great one. Also, there's timing with the income and expenses, which mixes into the last one, the corporate tax deferral. What I mean, so we were talking, I mentioned before, December 31st for a sole proprietor. But as a corporation, you get to pick your month end. And with the month end, we try to plan it on either when you're not as busy, so we can get working, or depending on the strategy you want, we can do it for tax purposes. The most common one that I see, especially for tax purposes, is September 30th. The reason being is now you have 3 months left of the year to make a decision on how much your T4 is going to be and how much dividends, because it'll be based on that corporate year, not on a tax year. So that's part of the planning development. Some red flags to avoid for CRA is rounded numbers. So basically anything that comes in without pennies, without cents, does trigger some questions with CRA. Losses year after year. The expected loss for starting a business is 3 years. And depending on what industry, they'll kind of blind eye 5 years. What I mean by that is when you first start your business, sole proprietor or corporation, the first 3 years, they know that there's going to be some loss. It's a guarantee. But if there's another 2 years, you got to be in a specific industry that records it. And with your industry, you don't get that extra 2 years in the realtors. So you don't want to have a pattern of always having a loss every year. Their computers, as I'm going to call it, the CRA computer, will pick that up and flag it. No receipts. Yes, I know it's even with the age today, you need receipts. CRA has actually become very flexible with receipts and now allows digital receipts. So there is 2 types. There's a digital and electronic receipt. An electronic receipt is when the initial receipt is actually done electronically. So it is emailed to you, most likely. So pretty much every utilities provider will email it to you. Your cell phone bill is emailed, type thing. You can go to Home Depot, you can go to I don't know about Walmart. Yeah, Walmart now has it. You can send it out electronically. That's great. That's going to keep it forever, and you can put it in a folder and keep it. The digitalized portion is when you take a receipt and you snap it, or you take a picture of it. You can take a picture with your phone. It's great. Those are the ones that they allow for thermal receipts. Okay, so thermal at the end of the day, in a few years, it will disappear. Or if you keep it in a damp environment or really hot, the ink's going to disappear. So they're going to allow that. Anything else that's scanned, you want to make sure that it's scanned through the bookkeeping system that you have. So either you're using QuickBooks or Sage or Waze, that system in the background, when you take it through that app on your phone, it stamps it digitalized in the background as an original copy. So it's just basically protecting it. So just taking a snapshot with your phone and saving it on your folder and then using it you don't have a backup there that they look for. Personal spending through your business. So we're not talking about sole proprietor. Again, this is corporate. When you use any personal spending through your business, yes, that is considered income you are pulling. There is some advantages to borrowing from the corporation, especially maybe you have to do a new roof or something. You have to put something on your own house or something big. And there is equity sitting in your corporation. You can actually pull it out, but by the end of your fiscal year end, it has to be paid back. If it's not, it's now considered a corporate loan, and you have to charge the minimum 2.5% interest on that loan. So watch that. You can play with it at the very beginning of your corporate year, do what you need, and then you got 1 year to pay it back. And also the red flags too. No bookkeeping until tax time. It doesn't matter if you're just starting out, you're sole proprietor, anything. You want to keep your bookkeeping intact. If you can do it monthly, perfect, but minimum quarterly. You want to get this. You don't want to give it to me or a bookkeeper at year end. Even right now in my office, anybody who gives me a shoebox and it's related to business, I don't touch it until May. We're too busy, and a lot of accounting firms are the same way. So you want to make sure that you're giving them some numbers, even if it's a Excel spreadsheet. You want to get something that's already readable and usable. Here's a checklist I put together. You want to do this on a regular basis annually. Keep separate bank accounts always. Keep your personal and business aside. And that the reason being it helps with audit review. But if you start using your personal account, even that you say, oh, I use this credit card, it's in my personal, I'm using it 100% for business. Okay, that's fine. We can record it. But if CRA realizes it's a personal credit card, you just open them up to your personal life for your business. So you want to keep that separate. Monthly bookkeeping, as I would recommend, at least quarterly. The mileage tracking, definitely, it's definitely going to help you at the end of the day. Part of the quarterly bookkeeping is the HST. You want to look at it at least every 3 months. Again, you want to make sure that the money's in a savings account, or just don't touch it. And obviously, tax planning. That's with me or another financial advisor or accountant will definitely help. And you want to make these tax planning moves before the end of January, because once February comes rolling in and it gets really busy, and they may not have time for you. So some final takeaways. Filing and planning, structure matters more than the deductions. And good advice pays for itself. And when I mean the advice, make sure the advice is coming from a credible source, not your neighbor of a neighbor down the street of a brother telling you some advice on that. I'm not too sure if you do any Q&As, I can open it up. If not, I can pretty much the end of the presentation.
We do. Do we have any questions? You can unmute, you can raise your hand. We love questions. Deanna, go for it.
Oh, I was going to say, hi, Michael. Good morning. Thank you for coming again. I saw that there's two in the chat, if there's access to those.
I think we can pull up the chat.
Yeah. So we have one from Anna. Is the square footage of washrooms counted as livable area?
Yes. Yes.
Perfect. And then we have a question from Aaron. Do you have a favorite QuickBooks or something else?
At the end of the day, if it's especially for people who are going to be using it and helping us, like you in the books, QuickBooks would be my number one choice. QuickBooks was actually built for the non-bookkeeper, for the non-accountant. It's built for you in your language. So definitely I would suggest that. Other programs like Sage, it was originally built for us. And then if you use it, you kind of have to learn more of our lingo. But there's other bookkeepings too. But I do find your investment in QuickBooks a little bit better. Yeah.
Awesome. Steph, did you have a question? I saw you unmuted.
I did, yes. And I might have missed it, so apologies if you covered this, but does your firm offer bookkeeping services as well? Like,
yes.
Are you a one-stop shop? Okay, amazing.
Yes, we are. Yeah, we have another division called Postings Inc. Postings, as we post 2 books. Yes, basically we will work together. They'll do the bookkeeping. We do payroll as well on that side. And at the end of the year, we're already in the same office. We will finalize your books for taxes, and we don't charge additional fees, really, because we're already in your books throughout the year in somewhat capacity.
Amazing, thank you.
Love
that. Any other questions? Anna is asking for your address, Michael.
Oh, okay. I'll give it. Yeah, I'll give you just. I just see one for the QuickBooks mileage. Yes, QuickBooks has got a great mileage tracker. It has been built in. It is approved for the IRS. I know they're trying to get CRA approval. What I mean by approval means that CRA doesn't mean they're going to accept it. It's just that means they endorse it because everything they want is on it. But yes, QuickBooks has got a great one there, especially if you got staff. Because if you got staff and you're paying them payroll, you can give them the app as an employee, and they can do some mileage tracking too. So yeah, it's a great one. Yeah, my address is obviously in Newmarket. I'm going to put this last slide up. Whoops.
And while you do that, Michael, we have another question in the chat here. Is it typical to see the HST included under box 20 in your T4A?
Yes and no. It shouldn't be, because it's not your money. And if it is, then you need to pull it out and make sure you got the backup. So give you an example. If you look on your T2125, that's your business, it'll show total income. Then right underneath it, the next line says minus GST. That is basically kind of giving you the way out of saying, yes, I made 50,000, but I got an extra 6,000-7,000 in HST and I put it on my T4A. Yes, you want to bring it down, but T4A is supposed to be without the tax, because it's only for earned income.
Hi, me again, Aaron.
Oh
my goodness, what was my question? So a good start. 12 years, I have 1 credit card. So that's bad. Is that bad? That's really bad.
No. And
like, should I have a business credit card? I just get so terrified about having more than one, but I've heard this before.
Yeah, you should. Are you a sole proprietor or corporation?
I'm sole proprietor, so.
Yeah, so you can get a business credit card in a sole proprietor name. It'll still have your name on it, but it is considered a business credit card. Again, it is good to keep it separate. But the only thing I mentioned is if you're still using your personal credit card, you got to declare everything on those statements and then say, this was for business. And usually as a true business credit card, everything that's claimed is business. You don't have to worry about it. So what the angle of CRA is, if you're using a personal credit card, what was this? Why did you go and spend this amount of money at this restaurant? They just become snoopy and nosy. And I've seen that so many times with auditors.
Perfect. Other questions before we, oh yeah, there is another one in the chat. Guys are on fire. I love it. Okay, so Caroline is asking, do you help with GST, HST electronic filing, or is that something we should reach out to a representative from CRA for?
Yes, we will help you 100%. I don't discourage people from phoning the CRA to ask a question, not how to do it. Okay, they got their ways. Remember, they monitor their phone calls, and if you ask certain questions, they'll be like, oh, let's maybe flag this return because they're asking too many questions. You want to know how to do it. That's it. I don't want to get into it, but yes, we will do both sides and not really give you any if there's bad feedback, we'll tell it, but it'll be constructive criticism. But yes, we do help, and we actually do the filing for you if you need to.
So good. Any other questions before we run away?
I guess it's just the address. So on my website, there's an address. This barcode here does just give you a 30-minute chit chat on the side. We are in Newmarket. We're at the corner of Leslie and Wayne. The closest major is Leslie and Davis. Leslie and Wayne. In the plaza, there's a edible arrangements. There's a piano studio. I think it's Holland flooring is in there. It's 17665 Leslie Street, Unit 35. Our unit is actually above edible arrangements. Even though it says 35, it should be 235, but that's how it was numbered here. The door-to-door office is right beside edible arrangements. You just go up the elevator and Will 35 will just be outside from there. Our website is fordassociates.ca and phone number 289-464-1001.
Amazing. Thank you so much, Michael, for your time this morning and sharing all the super helpful information. Everyone really appreciated this. So we're always so very grateful. Yeah, and now you know where they're located. You can go do your taxes and then you can go get an edible arrangement for your clients.
Yeah.
It's amazing.
I think everybody knows.
What you want.
I think
Yes,
everybody
thank
knows where
you.
edibles are, right?
Right?
Thank you so much.
No
That's
problem.
incredible. Everyone, have an amazing day, make amazing things happen, and then we'll see you all next time.